What's going on, everyone? Thank you for joining me for this video today, as I am going to be interviewing two of my favorite people in the entire world about taxes, and that is Amanda and Matt. What's up, guys? Welcome to the video.
Yeah, thank you. Glad to be one of your favorites.
How
Or
we
the
doing?
favorite.
How we doing?
Not just, I guess you could look at that phrase differently. You're not one of my favorites who do tax stuff. You're just one of my favorite, period. And you also do tax stuff. So you guys are awesome.
Awesome.
And the reason we want to do this video is because there are a lot of people today in the world who have money, who have extra disposable income. They make good money. They've sold some properties, whatever it is, and they want to invest in real estate. But the market's incredibly difficult right now to find anything. And so a lot of people are turning to this idea of syndication. I mean, my own company, I have a company called Open Door Capital, right? You guys have helped with that from the beginning. And we raise a lot of money from investors who have cash and don't want to do their own deals. They're going to work with us. So the question has come up over and over and over from our investors, and I know from the Bigger Pockets audience in general, and your guys as clients. How does syndication work with taxes, and what benefits are there? What are things you got to be aware of? What are all the concerns? So we're going to cover a bunch of that stuff today, and I'm just going to pick your brain. This is basically my way of getting free consulting from my CPA. So thank you.
I'm going to write that down.
We're starting to talk now.
There you go. Before we get into that, though, for those who don't know who you are, you guys are going to give a quick, 30-second rundown on your story, who you are, what you do, what your credentials are, and that good stuff.
Yeah. So I'm Amanda Hahn, and
I'm Matt McFarland.
and just so you guys know, we're married as well as working together as business partners. And I usually tell people we're investors, we're CPAs by day, and we're investors by night. So we're investors just like, most of the people that we work with. And our specialty is in helping real estate investors to use real estate as a vehicle to save on taxes.
Yeah, I'd say probably 80 to 90% of our clients are involved in real estate to some extent, whether it's kind of full-time or kind of runs the gamut to kind of what you were talking about, where it's people who still work at a W-2 job, working for somebody else, but are investing on the side, and they're kind of, trying to get more into it and what have you,
Yeah, that makes sense. And so you guys obviously have seen a lot of real estate tax returns. You've helped a lot of investors, both on the active and passive side, which is why I think you're the perfect one to talk about this stuff today. All right, so why don't we start with, I got a bunch of questions here, but let's go with just in general tax benefits. Are there benefits to actually being a passive real estate investor? Or does all that go for only the people who are active?
Yeah, that's a great question. I think there's a lot of myths surrounding that, where people say, hey, if you're a passive investor, that you don't get as many benefits as you do for single family. It kind of depends on the person, but generally speaking, there are, as a passive investor, you also get, one of the benefits of real estate investing is depreciation, which, we talk about a lot. And so one thing to keep in mind is, as a passive investor, you also get to utilize the same benefits that you do as, someone who invests in a single family home. And so, for example, if you have a rental building that you buy for $100,000, usually with, depreciation strategies, you might be able to write off, 15 to 20,000 of that of depreciation in the first year. And so when we're talking about syndications, it's taking kind of those same numbers and the same theory, but just, kind of supercharging that on a bigger scale. So instead of a $100,000 home, it's like a $10 million real estate. And instead of a $20,000 depreciation, maybe it's like a $2 million depreciation, right? So if you're just, one investor in a large syndication, let's say you own, 1% of the deal, your share of that depreciation is 20,000. So that works exactly the same way, whether it's your own property or it's like a syndication.
Yeah, that makes sense. What about, so maybe this question is going to come up a little bit later. We'll hit it, but I'm thinking about it now, so we'll hit it now. Let's say you're an investor you're a limited partner in somebody's investment. You're not a real estate professional. Actually, let me first ask that. What is a real estate professional, and how does that play into this thing? And then I want to talk about, like, so what can people offset from that depreciation? What can't they?
Yeah.
Yeah, real estate professionals is actually just a tax term. Okay, so it doesn't, a lot of people think that it means licensed as a broker or a realtor or something like that, but it has nothing to do with it. It's just for tax purposes, it means that you are somebody who's involved in the day-to-day business of doing real estate, enough for the year that you can qualify as a real estate professional, which is just for people to know, it's, you're spending 750 hours a year in real estate. You're spending more time in real estate than you do in your other jobs. And the third one is that you're involved in the day, we call it materially participating, but you're involved in the day-to-day stuff of your rentals. The benefit of being a real estate professional is that if you are able to generate paper losses on your investments, rental property, syndications, what have you, you can use those paper losses to offset all of your other sources of income without any limitations. So good example is, one spouse got a W-2 job for $400,000. The other spouse is a real estate professional with a $200,000 loss. They are able to, save 200, taxes on $200,000 of income. So they're only paying tax on 200 grand in that example. So if you're not a real estate professional, rules are, not tilted in your favor as much, but there's still benefits of, to investing in real estate if you're not a real estate professional.
Yeah, and since you brought up real estate professional, the one thing I would just like to add with respect to syndications, right, passive investments, which is our topic today. So if you are a real estate professional with respect to your own rentals, you can use losses from your syndications to offset not just rental income, but other types of income as well. There's an we call it an aggregation election that you have to do. This is not something technical that your CPA will do for you, but it is possible to do that, which, just makes syndication investments for real estate professionals kind of like an added perk. But I think what I want to make sure we talk about today, though, is, a lot of syndication investors are not real estate professionals, right?
Yeah, right.
They're just still working full time and just doing it on the side. And I think there's a huge misconception that people feel like, well, because I'm not a real estate professional, therefore I get no tax benefits. And today I hopefully will address a lot of those other opportunities for people who are not real estate professionals.
Yeah, so let's go there. So can a syndication investment, can it actually lower an investor's tax if they're not a real estate professional? How does it actually lower their tax potentially?
Yeah, well, I think maybe we'll use a very extreme example, right? Just to keep things simple, because we don't have a PowerPoint here today. So let's say we have a guy, Bill, right? And he makes $500,000 at his job, right? Very high income. And so let's say he's paying 50% in taxes for federal and state purposes. So, every year, half of that money is going away to taxes. And
which he's going to be super stoked about, to give away 250 grand of taxes every year.
Yeah, so that's just a normal, right? That's a normal situation. But let's say Bill invests in the syndication and, again, we'll just kind of keep everything, equal. So let's say the syndication is kicking off $500,000 of cash flow for Bill, right? And so for him, because of strategies that could be done at the syndication level, for example, depreciation, cost segregation, it's possible that maybe his taxable income from that syndication might be zero. So in other words, now, after investing in the syndication, maybe Bill actually has $1 million of income, right? 500 from his job still, or 500,000 from his job, and he has 500,000 of cash flow from the syndication, but his taxes didn't go up, right? He's still only paying taxes on the W-2 income. So I think effectively by increasing your total income without increasing your taxes is a huge tax benefit, because you get to keep almost 100% of that profit in the current year.
And I think a lot of people don't look at it like that. They're looking at, did I, lower the taxes on my W-2 job, and
not looking kind of at
the whole picture, right.
Yeah. Well, what about other income that they receive? Let's say the same guy, or the other guy who's earning $500,000. Let's say he's also making $200,000 every year in stock. I don't know, he's selling stocks or something like that. Or maybe, I don't know, does it have to be a long-term gain? Can that offset that because it's also passive income? Or can it just not offset any passive income at all if they're not?
It's a great question. It can definitely the syndication losses can definitely offset passive income, but in the IRS eyes, what's passive income is not interest and dividends and capital gains from stocks necessarily, but it's more like, Bill is investing in somebody else's business, like CPA practice, and getting a K1 from that, or investing in somebody's online retail business or something, and getting a K1 for that. He's not involved in that, so his share of the profits from that business are passive to him. So he could use his syndication losses to offset the passive income from one of those other type of businesses.
And I feel like I know why you're asking this question, Brandon, because
Brandon knows Bill.
Yeah. I know Bill. Me and Bill are buddies.
Or was it Bob? I can't remember his fake name. So, and it's a common confusion point for people because of the word capital gains. Okay,
Yep.
so in your example, you said, "Hey, I have capital gains from stocks,"
Sure.
and you can't offset those two. Okay, rental losses for capital gain stocks, unless if you're a real estate professional, right? But again, we're assuming this person is not. And so you can't just offset because one is stocks, one is real estate. Now, on the other hand, if we're talking about capital gains for assets like real estate, then that's a different story, right? So if I have passive losses from a syndication, I own other rental properties where I sell and I have capital gains, I can use the two to offset each other, regardless of whether I'm a real estate professional or not. And I think that's often a confusion point because in the tax world, they're both called capital gains, but capital gains from real estate is just different than capital gains from the stock market.
So what about then? So I got a buddy who sold a company, and he basically carried part of the contract, or as they say in real estate, is they carried the contract, right? So he owns like half the company still, but he just gets money every single month for that. And so that's just, it's like he doesn't run the company, he's not involved in the company, he's not even on, like, he's nothing, right? But he just makes his money. And the same can that be offset from the losses of depreciation losses on a rental?
Yeah, I mean, potentially, because it kind of depends on how that deal was structured. Obviously, like some of that's going to be interest, some of that might be capital gains from selling the business, some of that might be ongoing profit share because he's still a part owner. So it kind of just depends on what it is. But yeah, we've seen that too, where if you're just disposing of a business and you're getting capital gains paid out over time, then if it was a passive business to you or what have you, then you might be able to offset that with real estate losses.
I think a more common example we see would be, we have, if you're someone who's like a doctor, right? Family doctor. And besides being your job as a doctor, maybe you also invest in other, medical related businesses, right? Like little companies that make medical widgets, or you invest in like an assisted living home or something like that, where you're not the one making the widget, you're not doing much. In those cases, those are generally considered passive income to you, where then these, passive losses can offset each other.
Is there, and maybe we're going on a rabbit trail here, but I'm just curious about this. Like, if I wanted to then invest in a startup, like my brother-in-law is starting this tractor company and I want to invest with him. So I go and give him $100,000 now. And then I'm now a, 2%, 5%, 10% owner of this company. And I start getting money for that because I invested in that. Then that could be considered potentially just passive income that I can offset from the other things. Is that what you're saying?
Yeah, certainly. Exactly. So yeah, it's going to depend, of course, on, your brothers, how their company's set up and all that. But yes, it's certainly possible. And we do see that oftentimes, like, hey, just someone invested in a buddy's new restaurant, or we had one.
Or somebody invested in somebody else's fix and flip business.
Yeah.
Right. They're a passive investor. It's still real estate related, but it's passive to them. So when they get the K1 with profit, they can use their rental losses to offset that.
Yeah. One key thing I do want to say with respect to fix and flip, though, is because a lot of times people will partner with other people in a fix and flip as a lender where you get interest income. Okay. So that would be different because interest income is sort of like, interest from a bank or capital gains dividends. It goes into that other bucket where then the passive losses aren't able to offset. But if it's more of like from an equity position, right, it's a profit split where I am not actively involved in that business, that's where this potential benefit comes in.
Yeah, interesting. So I wonder if they're like, let's say there's a private lender who lends to house flippers. Now he charges, let's say 12% interest for his lending, and that money is not deductible. It's not offset by the depreciation on this limited partner thing. But if instead he structured it as, hey, I don't want any interest necessarily, I just want 20% of your profits at the end of the day, then maybe that would be. Am I looking at that kind of the right way?
Yeah, exactly.
So it's an interesting, interesting way. If you're like, hey, I know I'm going to get a bunch of depreciation this year off my LP stuff, maybe then I want to structure my private lending a little bit different.
Right. That's certainly a good way to look at it from a tax perspective. I mean, of course, there's, non-tax considerations too, right? If you're a lender, you're getting theoretically guaranteed interest versus a profit split. You're sort of
Yeah.
hoping and praying there's profit.
Yeah, fascinating. I never thought about that before. So does a limited partner, like in a syndication or like a passive investor, is there anything they have to do to get those benefits or all that stuff and the cost segregation and all that stuff, or is it just naturally flow to them, or is it?
And that's a great thing, is that a lot of that stuff, or most of that stuff, is taken care of at the syndication level. So
Yeah.
you as the passive investor, you're investing your money, and most of the syndications are taken care of, maximizing depreciation, choosing, doing cost segregation studies, whatever, to, bring that profit down as close to zero or even a loss on paper for all the investors. So that's, as a passive investor, that's actually a really good thing.
Yeah. I think just like with anything else, in the passive side, right? I mean, it's really the syndicator's responsibility to do everything related to that asset, in terms of getting the right management company, managing the cash flow and distributions, and taxes fall within that category. Where the passive investors, just like it sounds, there's nothing that they need to do to get those benefits. Of course, provided that the syndicator is, doing the right things, right, at the company level to make sure all that is being done correctly.
Let's say I invested in a syndication as a limited partner and I threw in, $1 million. And I got a huge, because I did the cost segregation stuff, I got this huge deduction. But I'm not a real estate professional. I'm not, I don't got any really income. I just got this massive, I don't even know what it would be. Let's just say this massive loss this year. Can I carry that forward or carry it back? Is that the right phrase? Can I affect other years maybe where I actually could use it? Or am I just out that year? It's oh, well, use it or lose it.
That's a great question. So for passive losses, if you're not able to use it, you don't ever lose it. Okay. So if you don't use it this year, you can carry it forward into the future indefinitely until it's used up. So let's say I didn't have passive income this year. Well, one strategy is next year, let's try to generate some passive income, because in that example, your next $1 million of passive income could be tax-free, right? You got $1 million sitting in a bank account.
And again, that can come from the same partnership that you had to show the loss in the first year. Maybe things are stabilized, they're kicking off a profit second year. Could be investing in somebody else's business, like we talked about. That doesn't have to be the same business, so those carry forward losses from the syndication can offset other passive income in year 2, 3, 4,
Yeah. And also if you let's say for some reason you never used it,
right.
And then the asset is sold. So in the year that you get rid of that investment, that loss is usable. It becomes actually an ordinary loss. So you can use that to offset taxes from all types of income, even if you're not a real estate professional. So it's very important, I think, for people to understand. It's not like what you're saying, I'm just out, that money, that's gone. You do get it. The question really, the difference from investor to investor is really timing, right? If you're a real estate professional, maybe you get to use it right away. If you're not a real estate professional, then you're going to use it either when you have the passive income or when you actually exit the deal yourself and you get to utilize those tax benefits.
But what about, how does then the recapture depreciation work? So let's just say I got $100,000 loss. I'm an LP. I got $100,000 loss this year, 100,000 next year, 100,000 the year after that, 100,000, and we do it for 5 years in a row. And just for easy math, every year got $100,000 in losses. Now, when I sell that property, let's say we sell it in year 5, or I guess you'd say year 6, but we sell it after those 5 years, I now have to pay back the recapture depreciation, right? So what is recapture depreciation and how does that affect an LP or limited partner in this case?
Yeah, it's so depreciation recapture is kind of like, on the front end, the IRS gives you the benefit of allowing you to deduct the depreciation, but it does reduce what we call your tax basis in the asset. So if in that example, the syndication sells in year 6, assuming they're selling it for more than they bought it for, this investor, if he got $500,000 of losses from depreciation originally, likely his capital gain on sale is going to be more than 500,000, because the first 500,000 is going to be recapturing the depreciation. Anything on top of that is capital gains. So the way that works is the depreciation recapture is going to be taxed usually at 25%, sometimes higher, but usually it's around 25%. But the benefit of that is if it's a passive investor who is in a high tax bracket, they're going to be able to deduct the original $500,000 at ordinary income rates.
Yeah.
In year 6, they're going to be able to deduct it at 35, 37%, pay recapture 25%, they still come out ahead.
Yep.
And then they're paying 15 or 20% on the rest of the actual appreciation of the asset. So it's a timing, like Jamanda was mentioning timing, it's a timing difference, right? But they're giving you the benefit up front and hopefully you can use it. If you can't, you're going to use it at some point.
Let's say I got a distribution. I'm an investor. I'm an LP. I get a distribution of like $30,000. That's what the actual, like the syndication I invested in paid me $30,000 this year. So does their K1, I'm not sure how to phrase it right. Their K1 doesn't necessarily show that they have 30,000 of taxable income for the year. Is that right? Like what, if I receive 30 grand, what's my K1 going to show? Is it going to show 30 grand? Do I pay the 30 grand, or is that where I don't pay anything potentially because it's going to depreciate?
Yeah, that's a great question. It's one we get a lot. Sometimes, when we're working with the investor on the investor side, right? We're doing projections and people will say, oh, hey, Amanda, I need to make sure you add another 30,000 to my income this year because I got a distribution from my investment. And so we always, ask follow-up questions like, well, what kind of investment was the syndication? What did the syndication invest in? And so a lot of people feel like, hey, because I got some money back from the syndication, that means it's taxable. And those are, for the most part, unrelated things, right? A distribution could be a return of your capital. It could be your share of the income that's being sent to you. But at the same time, your K1 is showing your taxable profit or taxable loss. And so we kind of go back to that example with Bill, right? Using those obscene numbers where, hey, he had 500,000 distribution, but taxable income wise, it was zero or even a loss because that's after taking depreciation and cost segregation. So those are, different things, right? Because you get distribution does not necessarily mean that's the taxable amount. And in most cases, those numbers are going to be very different.
Okay, that makes sense. All right,
Which is it's a great benefit though, right? You think about it, you just said it yourself, you got $30,000 of cash and you're not paying any tax on it, That's awesome. It's a win-win.
Yeah. Until if I have to recapture that, I might have to pay back some of it right later on, but at least that's at a lower tax bracket. And then potentially I just invest in another deal that year. Is that right? And then that can offset it again. Am I looking at that correctly?
Yeah, certainly. So, if let's say you did have capital gains from, exiting a syndication, or syndications flowing through gains or flowing through even positive rental income because it's doing so well. Well, if you're an investor who has your own rentals, right? You got some single family and duplexes and those have depreciation and losses, they're in the same bucket. So they can offset each other for tax purposes. Or if you're invested in a different syndication that's kicking off losses, then that can offset the capital gains from this particular one too. So all of those are in that same bucket where there's no limitation on the offsetting within there.
All right. So investors, investors can use a depreciation to offset the rental income from the syndications and get it down to zero. That would be awesome. That's what we're talking about. What happens a lot now is not only is the K1 at zero, but it actually is a huge loss. We're showing a huge loss. So some investors love that. Other investors get a little bit concerned. They're like, oh no, I'm losing money. Why is that? Can we go over that? Are they justified and oh no, we lost a lot of money this year?
Yeah, that question does come up a lot too. And it's, it's fair because, a lot of investors, they're not CPAs, obviously they're not doing real estate on the day-to-day basis. Right. But I think the misnomer is that, as Amanda was kind of alluding to, you can still have positive cash flow from a deal, but with depreciation, you can end up with a loss on paper for tax purposes, right? Because depreciation is based on your purchase price, which could be using down payment of cash. It can be based on bank financing too. So, if you put a syndication together with $3 million and you raise 3 million, but you get a bank loan of 7 million, you buy an asset for 10, it's quite possible that there would be a lot of depreciation that first year that could offset any cash flow that thing generates, right? So,
if we assume a $10 million depreciable asset, right? Maybe the first year tax write-off might be $3 million.
Yeah.
Okay. Using, cost seg and all that good stuff. And so even if the asset is generating $2 million of cash flow, right? Which is pretty good.
Yeah.
On the tax side, we're going to see $1 million loss because we got 2 million of income minus 3 million of depreciation, right? And so that's, that occurs quite frequently where, then the investor will say, wow, I got a huge loss on my tax return. But if they look into it, again, it's possible that this is actually 2 million positive, right? Just before all the tax strategies. So that's what we typically see, not anything to be alarmed about. It's fairly common. Of course, every deal is a little bit different. And so when we have investors investing in syndications, I always tell them, it's different where it's your own single family, you're doing due diligence on the property. For syndications, you're really doing due diligence on the syndicators because they're the decision makers. And you want to make sure that those are people who are reputable, who, have good experience, because that's who's controlling your money. So, of course, the goal and the hope is that the property is performing well, and the losses you're seeing are really just from the tax strategy side.
So I think this is where we say $2 million of cash flow. There's no guarantees when you invest in things, please consult with your team of advisors, et cetera, et cetera.
And if you're investing with Brandon Turner, just Google Brandon Turner and fraud, Brandon Turner and, jail, that kind of stuff, right?
Why doesn't he shave his beard?
Yes, exactly. People got to research these things. It is important. Yeah, I had a lot of questions from from Open Door Capital. We did the cost segregation stuff this year. We did a lot of heavy tax planning with you guys. And I don't know, we probably got 50, we have like 300 investors. Out of them, I bet you 50 of them reached out and was like, is this right? Like,
right.
Why am I showing?
I invested $100,000 and my K1 says I have a loss of $100,000. Like,
that's exactly what happened. Yeah. My buddy called me. He's like, you guys must have screwed up on something. I invested $100,000. I got money every quarter because you guys, we've never, we've hit distributions now every quarter. I'm making money. Why does it say I lost $100,000 is what I put into this thing? That doesn't make any sense to me. And I was like, I don't know, talk to Amanda. And that's actually what spurred this conversation to start this video and to do.
And that's when we responded via email. Google Brandon Turner and fraud.
Yes, exactly. Google Brandon's clearly taking your money, but it's
clearly this is wrong.
Yeah, clearly this is something weird here. But it just shows more and more the power of real estate investing. And this is a side note. I didn't really have this on my list, but if you guys had to guess, do you see this thing changing? Like, do you see the government, with the new administration and all the changes, do you see this changing in the next few years for investors, or probably not as well? I think is the way it is?
Well, I mean, there are always talks and threats of changes to the tax code, changes for real estate investors, because real estate investors are somehow dubbed as the bad guys, bad rich people. But so that's just something that's been going on historically speaking. There's not anything new here. So, I'm not super worried about it. I think things like depreciation, these have been benefits that's been going on for years. And it's not restricted to real estate. As business owners, you also get depreciation, you get a lot of write-off. So it's just, because as real estate investors, we have the concept of leverage, right? So, no money down or 20% down on a $100,000 property, your depreciation is based on a lot of the borrowed money too, which is why this is kind of a supercharged strategy. And then of course, when you take it to the syndication level, you're going from 100,000 to 10 million. Hence the numbers look much bigger. But I mean, if we kind of cut through all this stuff, what we're talking about here is really nothing new, right? As investors, one person, only one rental, it's really the same strategy.
Let's talk about those LPs who might have their own rental properties a little bit. So let's say I am an LP in a syndication and I got all these losses. I'm not a real estate professional, but then I sell a rental property of mine. I actually sell one of my properties and I make $200,000 in capital gains on the sale of a rental house that I own. Can that be offset from let's say I got $200,000 from my loss on my syndication? Can that just kind of cancel each other out?
Yeah, absolutely. That's the beauty of it, is because that gain on the sale of the rental is, even though it's quote unquote capital gains, it's also considered passive income for tax purposes. So passive loss from the syndication can offset passive income from other sources.
And we're kind of seeing this a little bit more in the last couple of years as older, just real estate investors who've been investing their whole life that, want to stop doing active real estate now that they're retired. But at the same time, they, real estate is kind of all they know. So when they sell their own properties, they don't want to go into the stock market and just learn all that new stuff. And so one of the things is, okay, well, if I'm going to sell, I don't really want a 1031 exchange into another rental that I have to manage, right? Because I'm just enjoying living a good life now. And so instead of doing that and, deferring the gain, they then, invest in a syndication that passes, passive income to them and also those losses can offset the gain on that single family. So we're seeing kind of a shift on a lot of, more older investors where they're like, hey, I still love real estate, but I'm just going at it from a little different direction now.
Yeah. Okay. So this is interesting. Let's just say then, and I think I know what you're saying here, but let's just say I am a real estate investor. I got a property. I'm going to make $1 million on this property. I'm going to sell. I've owned it for 10 years, 15 years, 20 years, whatever. I'm going to clear $1 million, but the market is super competitive and hot right now. So I know now is the time to sell. I believe, I'm hypothetically, I believe we're at the top of the market. Now is the time to sell. I do so. I sell in, let's just say March, and I've got $1 million in profit that I got to pay. Plus of course there's like recapture depreciation on that asset, but let's just forget that for now. I just got $1 million. I just walked out with a check from closing for $1 million. Of course I could 1031 it. Like you said, I could go buy another property, but I don't want to buy another property. That's the whole, it's the most competitive market in human history. Like I don't want to go and do it again because I'm going to be buying something that's not very good. I don't have time. I'd rather go and watch my grandkids grow up. So instead of trying to worry about the whole 1031 mess, and having the 45-day identification period and all that drama that goes with it. Instead, I just go take that $1 million, throw it to, Open Door Capital or, whoever, a syndicator, who then does a cost segregation. And if it was like what we did at Open Door Capital this year, which was you put in $100,000 and some people got $100,000 in depreciation. So, or in loss. So I take my $1 million, I invest it into a syndication, and I get $1 million, let's say, loss now, which now has this offset in my entire $1 million rental property. And I didn't have to 1031 for that to happen. I didn't have to do anything active to make that happen. It just washed out. And is that what you're saying? Am I looking at that picture right? Am I summarizing that?
Yeah.
I think he's got it.
Yeah.
That's amazing. I don't know why don't people talk about this more?
So yes, in your
what's-
example, that works. In reality, though, the numbers might not line up as much because
Sure.
So you've simplified it and said my taxable gain happens to be the dollar amount that I walk away with, right, in real estate. And that's not necessarily true all the time because that person that owned it for lots of years, they probably have depreciation recapture. So they have $1 million of cash, it might be like $2-3 million of gain for tax purposes, right? And so,
or if it was leverage, so gain and what you net proceeds you take out can be different.
Yeah. So, but I think you get the gist of it, right? The gist is, okay, so if in a more realistic scenario, I got $3 million worth of gain, right? I take $1 million of cash, I put it into a syndication that gets me $1 million write-off. Now I only have $2 million of gain that I'm paying taxes on. And I'm sitting at the beach, I got some passive cash flow coming in, right?
Yeah.
So the concept is the same, but just kind of depend on the numbers for each person.
Yeah. Yeah, I don't know. Like you and I have talked about this, and I've read both. I mean, both of your guys' book, or your two books, and for some reason it never sunk in internally, this whole thing. And it's like every year when we talk, and we always end our kind of strategy sessions, and I'm like, well, you have any final advice for me? And your answer, you always just say, buy more real estate. You need to buy more real estate. You need to buy more real estate. And I'm always like, oh, that's a good idea. But I guess now I feel like I'm finally like, oh, this is why, because I make a lot of income. I need to offset more of that income, and I'm getting a lot of capital gains on stuff. I need to keep doing this because the more real estate and the bigger real estate I buy, the more I can offset. And so, yeah, it makes a lot more sense now.
It's kind of sort of an addiction, for a lot of our clients, right? Yeah. That once they kind of get the benefit, they kind of try to go out over that year after year. And I don't recommend people make life decisions based on taxes, right? Just like I told you not to move to Hawaii because of taxes, but there you are, you love it. But for real estate, that's the same thing, right? If that's your asset class and that's what then, why wouldn't you grow that and continue that path rather than, doing something different like real estate or whatnot. But also I think, in terms of in that example, you said, okay, someone who owned a rental for many years, they sold and they want to take part of that gain and do a syndication to reduce the tax. We also have seen or suggested, I guess, times where maybe an investor tried to do a 1031 exchange. They had all the intentions, we're going to do it. And then it either is, failed completely or partial failure because they didn't meet all of the requirements, in which case then there's a capital gain. So one of the kind of remedies around that, right, after you fill a 1031 exchange and you got some capital gains, well, maybe you take that cash that you took out and put it in the syndication, which potentially will kick off some losses, which then helps to remedy this, bad 1031 exchange that you messed up on. So there's a lot of interplays in terms of like, how do you actually benefit and use the passive losses? And all these we're talking about are assuming you're not a real estate professional. Right?
Yeah. Yeah.
Well, again, I mean, I think it's probably worth, hammering home the point is we're talking about tax losses, right? The assumption here is we're making sound investments, right? And we're not investing in stuff that's actually quote unquote losing money, right? I mean, that's the goal here.
Yeah. Hopefully that, I know like there's been periods of time in the past where investors will do that. They'll buy deals, or even if it's not a good deal, just because they're trying.
Yeah, that's definitely not something people should be doing.
Yeah. Agreed. Staying on the 1031 for a little bit longer. I get a lot of questions from LPs. I get a lot of people who are in this problem where they're saying, I've got a property, I'm selling it. Can you take my 1031 money? And so investors want to they want a 1031 into my syndication, and we have to tell them no. Can you explain why that is? Why can't they 1031 into my syndication necessarily?
It's such a fair question because obviously in a lot of people's eyes, I mean, they're both related to real estate, right? So what's the difference? But in the tax world, the difference is that you own physical asset, right? You own the real estate you're selling that asset. The asset you're buying is actually a interest in a partnership, which is different in the tax world than the underlying real estate, even though the partnership's going to own the real estate, obviously. But so that's the hiccup that, a lot of investors run into, and the situations where they're trying to 1031 out of one, and hey, I found this syndication. It's a screaming deal, like the sponsors and everybody, I'm really interested in investing, and it can make it challenging. But, you were kind of hitting on one of those strategies earlier, right? You can just not do the 1031, recognize the gain, and then hopefully you get your, offset by the syndication loss on the front end. But I mean, there's other ways to do it too. I mean, there's different ways to structure. There's sometimes people go into these they set up tenants in common interest where the investor comes in as a 10% tenant in common with the LLC that owns the real estate, or a bunch of other partners that own the real estate, and that way you can use 1031 that way.
Yeah, I mean, there are syndications who are set up as DSTs, Delaware Statutory Trust.
Yeah, there's that too.
Which is a syndication and can take in 1031 exchange money. So it's a little bit more straightforward in terms of like implementing an actual 1031 exchange, but it's not as commonplace. Most syndications that we see are still set up as LLCs, which is where that hurdle comes in of like, well, if I'm doing if I'm selling a property and replacing it in an LLC interest, that's where the 1031 becomes a problem. But I think in either case, for on the 1031 exchange side, even if you can't replace it in a particular syndication because it's an LLC, like Matt said, you can always use some offset strategy, right? Just might not defer the whole tax, but at least maybe part of that could be deferred using the passive losses.
Is there a guess or like a general, I'm curious the difference. Like if I'm talking to an investor, an LP, and to go back to the number we said earlier, they got $1 million in profit and taxable gain that they're going to get from, let's just say again, for a simple thing, the taxable gain is the exact amount that they're actually getting. So $1 million they're actually getting, that's their gain. They're going to owe taxes on that full amount. They're going to end up owing, I don't know, let's call it 300 grand in taxes because of that. So if they were instead just going to just sell it, not 1031 exchange, and then invest in a syndication, what's like, if we were to compare those two options, what might that look like? Like are we talking like they're going to end up paying 100,000, like 1031, they pay no taxes. If they do nothing whatsoever, they just sell it and then go buy a car, they're going to pay $300,000 in taxes. So what's kind of that middle option of sell it, pay the capital gains, but offset it with depreciation by investing the whole $1 million in another property with a syndicator? What's that look like?
It really depends on the syndication, right? And what the asset is in the underlying syndication. If it's like a apartment building, mobile home park, something that, you're generating a huge write-off, like we talked about earlier, it is possible that an investor puts in $1 million and gets $1 million immediately, right? Yeah. Where that offsets each other. But it could also be another asset class where, hey, someone invested $1 million, their first year K1 loss might only be, 300,000 or 500,000, in which case that's, a little bit lesser of a benefit. So, it's hard to know without knowing exactly, what is that investment within the syndication to be able to gauge like, what is the differential on that?
Well, let's keep on the 1031 a little bit longer. So now I'm going to sell, I'm an LP in somebody's fund, like somebody invested with Open Door Capital. They put all this money in. 5 years down the road, we sell this property and they're going to make a big chunk of money because we're so awesome at Open Door Capital. And they're going to go and walk with them. They put in, whatever. They put in a few $100,000. They're going to walk with $1 million. Woohoo. I'm not promising any kind of returns here, but 31.
Consult your team of advisors.
Yes, exactly. Consult your team of advisors. Can they take that $1 million now and 1031 into something else? Can they take their profit from the syndication and then 1031?
Yeah. Great question. So same limitation as Matt was saying earlier, right? As an investor, so if the fund, the syndication sells an asset, the syndication can decide to 1031 exchange. There's no restrictions around that. At the fund level, you say, hey, I'm selling it, I'm 1031 exchanging it. However, practically speaking, we rarely, if ever, see that happen because that just means all 50 or 300 of us are now going to the next deal, right? So we've seen it sometimes where the deal sold a lot quicker than you expected. It was like a similar replacement, but usually we don't see that happen, even though you can do it. So the more frequent approach we see is then the K1 is going to kick off a huge gain to the investor. Unfortunately, investor cannot just 1031 exchange ownership, gain from a partnership or LLC into a different asset. But what they can do is they can take that profit and just, invest in a different syndication, right? And that different syndication might kick off passive losses again.
Or they have their own rentals that have losses they haven't been able to use yet. Or
they're like, hey, I'm going to take this and buy my own apartment building or buy my own mobile home park and kick off my own losses, which then can offset the gain from this sold syndication. So there's a couple different, so even though you can't do a 1031 exchange at the investor level, there are still a lot of what we call offset strategies, right? Different ways to offset that gain outside of a 1031 exchange.
Which just reinforces what we talk about all the time here at Bigger Pockets. And I mean, anytime real estate conversation is consult like this, like a CPA is not somebody who does your taxes. I mean, yes, that's what they do maybe, but like it's so much broader than that. It's a ongoing conversation. Something that you've I don't know, say yelled at me about in the past is like doing things without talking about
that's a strong term for it.
Yeah. You have corrected me a few times of like, you bought that. Why didn't you talk to me about that first? Like it's an ongoing conversation with your tax advisor who understands real estate investing. Because there are so many CPAs out there that just have no idea about any of this stuff. They don't know any of this complex.
Which is totally, again, it's totally fine. I mean, it's, all CPAs do different things. Doctors do different things. Attorneys do different things. Yeah. It's totally fine. It's just, as an investor, you want to make sure, like you said, you're working with somebody who understands real estate. If that's your, chosen asset class to invest in.
One thing I wanted to add is, it's as an investor, I think, if you're an investor who's not a CPA, right, yourself, your main job is really not to understand all of the rules and regulations. Your job really is to just make sure you keep your advisor updated. And it could be a simple email like, hey, I'm thinking of doing this, or I want to do a syndication investment. Should I use my cash or my retirement account, or should I refinance and pull the equity? Because a lot of these all have different tax implications. And it's up to your CPA to help you kind of strategize through those, but they do need to know before you pull the trigger. Especially when it comes to passive investments, I think a lot of times passive investors don't think about that investment, right? It's passive. I just wait for my K1. Even yesterday, I had a client who say, oh, by the way, here's a K1. I know where you filed my tax return. I'm like, what do you mean? But you didn't even tell me until this, And so
that never happens.
Most of the time, even though you're a passive investor, you still want to know, like, for the most part, the syndicator will let you know, hey guys, we're going to sell this property in the next X number of months. You're going to expect a gain. So that's the time for the investor to say, hey, contact my CPA. This deal is going to be sold. What should I do? What should I be looking at? Because then your CPA might say, well, why don't you look for other passive investments to offset the gain? Or maybe do you want to buy more rentals with that money and we need to start shopping, before the end of the year. Right?
Yeah. Okay. That makes perfect sense. So let's go to the idea of, let's say I am, this whole thing we've been talking about is like not real estate professional. So that's just for those people who are a real estate professional, or maybe their spouse is a real estate professional. And that can be like real estate agent, right? Or also investor. It could be either of those, right?
That's a good question. So to be a real estate professional, you don't have to be an agent. Okay. And also, just because you're an agent does not automatically mean you're a real estate professional.
Okay.
Real estate professional really is looking at the hours you're spending with respect to your rental property. So being an agent could help, but it doesn't mean, hey, just because I got licensed, now I am a real estate professional. Still need the hours and the rentals.
It's weird to me that the government has that distinction. Is that weird? Like being a real estate agent is a salesperson's job that has nothing to do with real estate other than the fact that the thing you're transacting in is real estate. So I feel like real estate professional should be you own real estate and you're working on your real estate. It's weird to me that it's like, oh, that also includes you're selling other people's real estate. Cause then the guy down working at Macy's perfume counter should also get that, like he's also selling a item. I don't know. It's weird to me. But whatever.
It's true. But I think though the intent of the law is really in agreement with what you're saying is that okay, to be a professional for tax purposes, it is looking at the time that you're spending managing and dealing in your own rental properties. It's just that if you also happen to be a realtor or broker or flip houses or do wholesale, that helps to supplement the hours, right? Doesn't mean you don't need rental hours, you still do. It's just that those extra hours help you. But I see what you're saying. If you're selling perfume, I mean, how's that different than selling real estate?
Yeah, I feel like they're like, I don't see how they're that different. I mean, they're obviously different, but yeah. Anyway, so let's talk about, so those people who are real estate professionals or their spouses, right? They don't have to be, their spouse could be, and correct me if I'm wrong on that, but now how does this all change? I mean, now I'm getting this big loss every year of $100,000. Let's say I got $100,000 loss. Now I can offset my W-2 income with that or no?
Yeah, that's the beauty of it. I mean, as a real estate professional, likely they are, obviously have their own portfolio of rentals, which is helping them qualify as a real estate professional. And so they're likely using those losses to offset their other income. But now if they invest in other people's syndications as a real estate professional, they can use the losses from those syndications to also continue to offset their W-2 interest, dividends, other business and whatever they have, that's the beauty of it.
Yeah. Because the IRS allows you to what they call aggregate your real estate activity. So, instead of saying, hey, every single rental property is its own thing, you're saying all of my real estate investments are within one bucket. So that's where you can say, okay, I'm including all my own rentals plus the ones that I have in partnerships, LLCs, syndications, and things like that. So yeah, it's a huge benefit, for investors who are, real estate professionals to be in, rental real estate and getting these losses.
Yeah, it's a big enough benefit that some like LPs might be thinking, well, I got a full-time job. I'm not going to ever qualify as a real estate professional, but my spouse is only working part-time right now. Let's give them some duties, right? To make them work that, whatever it is, 15, 20 hours a week, whatever 750 is a year. And let's make sure they qualify as a real estate professional, right? Do people do that as like, because it could be such a big difference to them?
Well, so I think the underlying assumption here, though, is that spouse, right? So, or the taxpayer and the spouse, they have to own their own properties.
Okay. Yep.
So you can't just say, hey, I've got 20 passive syndication investments, therefore I'm going to be a real estate professional. It does have to be actual properties you own. So the normal profile would be like, you're working full time, your spouse is, has your own little rental portfolio on the side where maybe she's self-managing or she's doing the BRRRR strategy where she's a real estate professional. And now also let's invest in, one or a handful of syndications and be able to use all of the losses together. But it is difficult if you're saying, hey, I don't have any of my own rentals. All I'm doing is syndications. It's going to be very difficult, if not impossible, to qualify as real estate professional because as passive investors, we all know you can't be active, right?
Yeah.
And that's the good and the bad of it is you can't be active. You're just getting, true like mailbox money.
Well, what about like, let's say there's a doctor and his wife, or also let's go doctor and husband. All right, we'll keep this the opposite gender that people usually think. The doctor is the woman. She is making $500,000 a year as a doctor. She's an anesthesiologist. Her husband is semi-retired. He's basically retired. Maybe he has his own business he's been doing for a while. And then they realize, well, they're paying almost 50% taxes on her $500,000. They're paying a lot of tax on the $500,000. Plus their LPs and all these real estate deals are getting a lot of, deductions. But because it's doctor income. That's all they're getting primarily is doctor income and other like self-employed income. They can't use any of the losses from that over to offset their doctor income. However, if this husband then says, you know what, I'm going to take a more active role in flipping houses, let's say, and I'm going to be a real estate agent. I'm going to help some clients. And now I'm working 20 hours a week, roughly doing this stuff. Now, are they able to I would offset the doctor income based on the money coming in from the LP side?
So I would just change your facts a little bit,
Okay, please.
because again, so the husband does have to have time in rental real estate
Okay, now
to
not
be
flipping.
a real estate professional. So maybe instead of flipping, maybe the husband decides to do a lot of BRRRR projects
Okay, perfect.
instead, right? Still rehabbing, but we're not selling it. We're keeping them as long-term rentals. And then if he meets hours for real estate professional, then this is all wonderful. And, you can use all these rental losses from the BRRRR and the syndication and use it to offset the, wife's physician income.
You said earlier that real estate agent work can add to the hours there. So what if like I own one rental property? It takes me 5 minutes a month to be able to own this rental. I work 30 hours a week at my agent business. Am I a real estate professional?
So the way it works is, so for the definition of real estate professional is that you spend at least 750 hours in real estate and more time than your job, right? So that's step one. So if you don't have another job like this husband, then he needs 750 hours in real estate in total. And that can include rentals, being a realtor, being a flipper, all of that is the 750 in our example. Okay. So step one, he's met it. That's real estate professional.
Okay. Yep.
Now, step two, in order to use rental losses to offset other income, he has to have usually, it's what we call material participation in the rental activities. So there's 7 rules for that, but one of the most common one is 500 hours in the rental activities. So that's what we were saying, okay, if he's doing a BRRRR, which is a rental, right? In the BRRRR transaction, if he's spending 500 hours, then he meets that second test of material participation.
But again, it's got to be the kind of, we call it the boots on the ground. It can't be 500 hours of, maybe he's got 50 properties. Like you said, he's spending 5 minutes a week on each property. At the end of the day, that might add up to over 500, but that's not the right type of time for the material participation test. So it's got to be more really involved in the kind of the BRRRR in that example,
Yeah.
Interesting.
So I like your example, but just change from the flip to rental. I mean, at the end of the day, I think you start with, okay, do I have rental real estate?
Yeah.
Right? Do I have rental real estate I own? And how much time am I spending in my rental properties? And then go up from there.
What about, can you use like education time or networking time to qualify for a real estate professional as well? Like, I listen to a lot of real estate podcasts. I'm reading a lot of real estate books. Would they count any of that or no? Probably not.
Yeah, that's such a great question that we get all the time. And I think there's a lot of investors ask that, and even CPAs responding to it. I think a lot of people take different positions on what that is. So, the way that we look at it is the 500 hours of real estate time we were talking about, right?
For material participation.
Yeah, boots on the ground, material participation for your rentals. Those generally don't include podcasting and things like that because they're not really specific to a property, but we do feel that counts towards the 750 of material participation.
750.
I mean, 750 of real estate professional time, because that's just like, as a realtor, as a broker, there's other things that you're doing. The thing that to keep in mind though, with like podcasts and things like that is sometimes those things are very difficult to prove. Right? And say, hey, there's always a podcast on. There's always something I'm reading or blogging or listening.
I'm always listening to Brandon every day.
Yeah, every day, every minute of every hour.
It's very difficult to prove. And so not that it's not allowed, it's just you have to be careful. Everything you do in tax has to be reasonable. And you really want to make sure that your documentation is reasonable for what is needed and what you're doing. I mean, even, if we take the education stuff out and say, how much time is reasonable for me to, change a toilet, right? Yeah. Is it, is it a couple hours? Is it 100 hours? No, that's probably
that would take me a long time.
Right?
It is a long process. I've done a lot, too much of that. Oh, what about tracking this stuff? And then we'll move on from the real estate professional stuff and start to wrap things up. But if, like, it would be meticulously annoying to have to track every single minute of my day. Oh, I took a 5-minute phone call about this rental property, did this thing right here, did this thing right here. that just is a burden I can't imagine anybody on the planet actually doing, is tracking every second of the day, how many minutes they're spending. So how do people justify this to the IRS that they are a real estate professional?
Yeah, and I think it's going to differ from person to person, right? But the tracking of it is really, really important, because if you were to be audited and if the IRS were to say, hey, prove to me that time was occurred, right? One of the best ways to show it is to have a time log. And what they'll do is they'll take your time log of, I don't know, 200 entries, and they'll do a sample selection and say, okay, let me randomly choose 4 or 5 days. And if you can prove that those things occurred, then great, right? And so from a documentation perspective, you always want to start with the end in mind, right? How much detail do I need? Well, I always tell people you want to have enough detail where if you're audited 2-3 years from now, that you can easily be able to figure out how you're going to prove those things. Is it a receipt? Is it a phone call? Is it a chat? Was it an email? And be able to prove those types of things. I think auditors are reasonable as well. So they'll take a look at your profit and loss. If you said you spend, 100 hours rehabbing this property, well, you better have a lot of expenses for that property, right? If there's a P&L that shows almost no expenses and you said, I spent, so many hours rehabbing it, then, the facts just kind of don't match, right? So they will take reasonable documentation to kind of arrive at, okay, what was the before and after rehab to get to the end result.
And I think from based on experience of, reading various court cases with real estate professional, the other thing too is the more organized you are, the more weight they're going to put to your records, but if they're auditing somebody who, and it's a mess and they don't have a time log and say, hey, I got one, I can go create one. They're not going to put a lot of weight to that, when you're trying to create something from 3 years ago, so that's from an outsider looking in, it does help, obviously, if you can keep your ducks in a row and get organized sooner than later,
Yeah, I think there's been court cases where they disallowed education time because it's, maybe an investor who owns like one rental property and has hundreds of hours of education, where it's like, well, that's excessive. Really, you can't really prove that you're making with real estate. But there's also been court cases where they allowed investors to include education time and time researching into properties where, it's clear that, they're so actively involved in the real estate that the education is just part of what they're doing to continue to grow, a fairly large portfolio, right? So I know there's a lot of scare tactics that people talk about, oh, IRS is super scary, but, usually they're very reasonable people. Of course, you still want to have your documentation.
Yeah, that makes sense. All right, a couple more quick questions on this. You can't combine husband and wife hours, right? Like one can't work 400, one work 350 hours, and now we've got 750. It's got to be one.
So in that example, you can't combine it to get to 750. But the strange thing is, we were talking about the material participation for your actual own rentals.
Yeah,
you can combine husband and wife time to meet that standard.
Interesting.
Ask me why. I have no idea.
Hey, it's never an easy answer, Brandon. When you ask a tax question, it seems very easy what you ask. Of course, the answer is so complicated. I'll just add another layer real quick because I don't want to go too much into the woods. We usually talk about material participation is 500 hours, right? In all of your rental property hours combined. Like I said, there's like 7 other tests. So the other common one that people can use is at least 100 hours in the rental and more time than anyone else. So, if you have a rental property that maybe you self-manage, there's no one else working in the property, you kind of, mow your own lawn and do all that kind of stuff. Even if you're only spending 100 hours, you might be able to meet material participation for the tax benefit.
Okay, interesting. And then last one on this one, vacation rentals, does that count as well? If you own some vacation rentals, can that be called real estate professional?
Should I say it depends or not?
Oh
there's no good answer. There's no easy answer.
You think it's an easy question, and then we go into the woods of tax world.
Let's just say that we call them short-term rentals in the tax world, but
Sure, yeah.
There are ways to get benefits. If you're able to generate losses on short-term rentals through depreciation, maximize your deductions. There's ways to take those losses and benefit against other income, actually without qualifying as a real estate professional. But they would need to be a short-term rental, where the IRS looks at the average rental period is 7 days or less for the year.
Okay. Yep.
And that's a common misconception because a lot of times people feel like, hey, my property is on Airbnb, therefore it's a short-term rental. But that might not be the case because for tax purposes, you're looking at the number of days, the average number of guest days, and also you're looking at if you're providing hotel type services, right? So that's a key thing too. But, if you're operating, a short, quote unquote short-term rental, but the average day is longer than 7 days, then it is treated just like a long-term rental for real estate professional purposes. And it's all in that same bucket.
Well, this has been awesome, guys. I know we covered a ton of stuff today. We got a couple minutes left. Anything else you want to kind of close with? Any other point? I didn't ask you anything that you get asked about a lot and you just want to make sure we get in this video?
For everyone out there listening, it's definitely be in touch with your advisors. It is, whether it's us or somebody else, it does help plan things when they know in advance of what's going on. I know we talk about that all the time and we stress that to you, but it's but it's no joking matter. It's a lot easier to help somebody plan something, if they are talking to their advisors before they pull the trigger on something.
Yeah. And I like that what you said earlier, like your CPA is not someone that's doing your tax returns, right? That's something they could do, but your tax advisor is someone who's advising you throughout. And so, as investors, there are always core things that we should be doing. So it's one thing to read a book and listen to a podcast and understand the strategies. It's a different step than to implement the strategy. So we talked about, real estate professional. So now you know the roles, doesn't mean automatically qualify. You need to know what activities qualify for real estate professional. You need to know how do you track those, and you need to actually be, tracking them during the year. Or, it's more than just understanding what can I write off, but really having a system to, track those expenses. And, a lot of investors don't have the ability to hire a full-time bookkeeper to do those things. And so it's really important for every investor to make sure they have their own system, or if they don't have one, work with their tax advisor to develop a system so they know, okay, what can I write off and what do I need to keep and how do I make sure I'm set when I come and meet with you again next April? So I have already captured everything.
Awesome, guys. Well, thank you so much. Where can people find out more about you and your company?
I don't know. I think the best place to go is our website, which is www.keystonecpa.com. We have a free downloadable ebook and a lot of tax updates that we throw up during the year. And of course, our Bigger Pockets book that they can check out on Amazon. It's called Tax Saving Strategies, Tax Strategies for the Savvy Real Estate Investor, and the book on advanced tax strategies. A mouthful.
Yes.
Yeah. We like long book titles at Bigger Pockets, apparently. So thank you guys very much. Appreciate it. And for everyone watching this, if you enjoyed this video, don't forget to give the thumbs up below the video. Leave your comments below. And we'll see you again on another Bigger Pockets video. Thank you, guys.
Thanks, Brandon.
Bye.